We have here with us Shashank. You might know him by the name Value Educator. He's got a very big YouTube channel that provides us with a lot of insightful content. Um, he also goes by the name Value Educator on Twitter as well. He's a value investor. He's been a value investor for a while, and he specializes in the chemicals and the pharmaceutical sectors. So we'll kick things off with the first question. So Shashank, can you share with us your personal journey and how over time you became interested in the markets?
Yeah, sure. So before that, very happy New Year to everyone. And there were some glitches on Twitter. Sorry for that. So we can start it. So basically, I started uh, like my journey when I was about 10 or 11 years, just by watching the ticker on a CNBC. So my dad used to have some investments in stock market, and then he used to ask me like क्या ये शेयर का भाव क्या है या पंजाब ट्रैक्टर्स का भाव क्या है. So I just used to call him when he was at office, and I used to tell him just the prices. So from that actually it started my journey. And then basically it was limited initially just to check the prices and what nifty is doing up and down. And then actually when I was in engineering by education, I am a electronics and telecommunication engineer. So during that period of time, then I got introduced to Mr. Ramdev Agarwal by watching YouTube videos or some of his wealth creation studies. And then I got fascinated with basically the investments and the long term wealth creation. And then actually when I was in my school days or in basically engineering, so I was a bit good in maths. So I immediately understood the power of compounding. So I think it's actually a seventh wonder, what I feel. And definitely the one who understands it actually can create a lot of wealth, and the one who cannot, I think he pays for it, as I think Albert Einstein has mentioned in one of his quote. So from that, basically it started, and then initially I didn't had any capital, neither any knowledge. So I thought let's understand this space more, and then I started with a very basic research, understanding about the companies, understanding like trying to read the annual reports. Most of the thing I not used to understand because of I didn't had any accounting background, because as I mentioned I was from the technical background. So I think learning is a process. You cannot learn or cannot invest and create a huge wealth in a very short period of time. So from a day one, actually my passion or the thing which I wanted to do, I wanted to do some business. But I didn't had any capital, neither I had any knowledge. So when I was in basically in engineering, about from third year, I have to do something from which I'll get my initial capital. So during that time, I started basically my own coaching classes. I used to teach few juniors from engineering for second year juniors, like maths and physics and various subjects, which I was a bit better. And then I started with other standards like 11 12 standards and so on. Then finally created some team about 15 20 teachers with me, and that's what got my basic initial capital. Am I audible?
Yeah, loud and clear, man.
Okay,
This is
just check.
perfect. So yeah,
Yeah.
for the next question, thanks for sharing your journey. Pretty interesting. So I guess for the next question, how do you look at portfolio construction? What are your views on like a concentrated versus a diversified portfolio? And do you have a typical holding period, or do you have like a satellite portfolio as well? Uh, what are your views on portfolio construction?
Yeah, so right. So my journey actually started with reading about Ramdev Agarwal and then Warren Buffett and the well-known investors. So I was from the day one was sure that I have to have a concentrated portfolio to make something uh, worthwhile, stock market. Like I am not in the favor of like investing into 50 and 100 stocks. I always had that thing in my mind that I don't have to cross like about 30-35 stocks ever in a portfolio to have some good understanding. But initially, as always start, that we don't have any understanding, just we know the superficial knowledge by reading books and listening to various interviews. I think the real journey starts when you do some mistakes, you fail it, and then you really understand what is the concentrated portfolio and how much pains and effort it takes to create a concentrated portfolio. So now also I'm like more of a concentrated portfolio approach. I take about 10 to 15 stocks for me as personally, and for I'm managing certain private investors accounts also. So for them I generally go with about 20 to 25 shares in account. But I think we should have firstly some filters in our mind, because there are 5000 listed stocks, and it is impossible to study all of them in one lifetime. So filters can be in various forms. Either they can be into the financial numbers, and you do the various screening, and then you come out with like whatever 50 100 stocks you can study. Um Apart from that, I think you should have some circle of competence, which again Warren Buffett mentions. So you have to understand few sectors very neatly, or you can say in depth, compared to like whatever others can, or compared to other sectors which you are interested into. So for me, right now it is a bit of a chemical and pharma, which I feel I have a bit better understanding compared to other sectors which I'm tracking right now. I might be tracking about 4 or 5 sectors at the max. But right, I have developed this competence over the period of time. It's not like uh, it has happened in last 2 3 months or last 6 months. Um, and maybe I was from the technical background. I have got that bit of an advantage to understand these sectors, because I think they are very technical sectors. Many terms we come to know, like which are not used into our day-to-day life. So on a portfolio construction, I feel it's more of a whatever knowledge you have. And number one thing I think one should think while building a portfolio or constructing a portfolio is understanding a competition into industry. So like I'll give you some examples as well as we go ahead. But I think most of the investor who starts investing, they look for the numbers. Like they will check the revenue growth, they will check the profitability growth, they will check some ratios, ROC, or maybe later on the cash flow statements and some debt to equity and all. That is all okay. That is good. But I think understanding of a competition is not directly given into the numbers. It might be the outcome, but I think it's not the start. So like for example, uh, clean sciences, the IPO which came now. So if you understand the chemistry behind it, and the process innovation the management is doing, the products which they are basically manufacturing, uh, the more in-depth knowledge about the processes or products, and so the management, how technocrats they are, then it will automatically get, I think, linked to the numbers. But if you start with the numbers, and if the numbers are bad today and you think this stock is not good or this industry is not good, and you will skip, then I think you may miss some uh, uh, some wealth creation in future. So I think understanding a competition in any particular sector, be it a chemical, be it a pharma, be it any other sector, it's very very important. And what are the entry barriers which are there today, and how long they will last. So basically we should have to look for the entry barriers, plus what are the basically the growth perspectives, or what is the growth which is likely to happen in future. So I think once you understand the competition, everything else I think falls in place. You can easily understand what kind of growth this industry might have, or it also becomes very easier to understand the basically the other ratios, other financial parameters. Another example I will give, like Poshak, which is into forgination as a chemistry. So if you understand a bit of a chemistry, what forging is, how, why it is very, what you can say, very regulated space, why government is not giving everyone the they are not allowing everyone to manufacture the forging, because it is very toxic gas, and it's quite difficult to handle that. I think I have today only uploaded one of the video in which I have mentioned that if you check the Bhopal gas tragedy, so it was a huge tragedy, and if you check the particularly chemical which was there during which was got leaked, it was one of the derivative, downstream derivative of a forging. So that itself is a niche which that particular uh, business has have created, and they have about more than about 30-35 years of experience into forgination. So if you check market cap of Poshak is about 2500 crores right now. But even if the bigger player, which might have 50,000 or 1 lakh crores market cap, or let's assume 5,000 crores of sales, like for example Aarti Industries, which have about 5,000 crores of sales and 35,000 crores of market cap. So they cannot enter into forgination because they won't get those permissions, because they don't have their competence into forgination. They will have into something else, like for example Aarti have into benzene. So if you check, this sector is completely different compared to some other sector, because here, even if the small even with the smaller players have their own niche and their, what you can say, the circle of competence, and generally other players won't come into the niche which is created by other players. So that's why understanding this sector is bit different, and the opportunities also are, I think, there are huge. We can discuss that as we go ahead. So this is the basic about how I look for the portfolio construction.
Fascinating, Shashank. I also wanted to know, you spoke about developing circle of competence, and you spoke about, 4 or 5 sectors that you track. So
Right.
I wanted to know, in that 10-15 companies, what percentage of it is allocated to pharma and chemicals, and what are some of the other sectors that you're invested in?
Yeah, sure. So I'll start it with the number of sectors, or which other sectors I think might be better in near future or for a midterm. So first one definitely is a chemical and in chemical also there are various sub sectors, like commodity chemicals, specialty chemicals, agriculture related chemicals, agrochemicals. Then in agrochemicals also there are various again segments, like some of them are based on, what you can say, the pesticides, insecticides, herbicides, fungicides. So chemical industry itself is a very vast and big industry. Same about the pharma. So if you check about the pharma, then there are formulation based players, then there are API, pure play API players like Solara, then there are CRAMS based players like for example Suven Pharma, or Divi's Lab, some portion of it. So these definitely are there. Apart from that, then I'm quite bullish on the platforms. I have tweeted extensively about the IEX from about 150 160 rupees, and right now I'm in basically pre bonus. Right now I think it is trading at some 200 rupees. There has been a bonus. Then there are like similar some other stocks like CDSL. I think that is another good business. It's definitely a bit cyclical, but on a bird's eye view, I think this platform as a sector, I think I am quite bullish on, because various platforms have their different product. It's, if you think it's like a chemical kind of a thing only. So CDSL have created their separate niche. There is a duopoly in that sector. If you check IEX, there was again a duopoly, while IEX was having about 90% of the market share, and right now there is a third player which is entering into that sector. So I always look for this monopoly, duopoly, or very limited competition, as I mentioned in, I think, previous answer to the question, that first thing which I look for while understanding any sector or any business is like I try to understand the competition into that sector. Once you understand the competition, all other things will be very easy to understand, and you'll able to connect the dots very easily. If you don't understand the competition, for example, in the case of telecom sector, I have never invested into telecom sector. Probably right now the scenario is a bit different. But if you check, or if you try to understand that sector, you know what has happened after 2016-17 when the Geo has entered into the sector, and then the like the downfall of Vodafone Idea, and then there was a big what you can say, the dent on the balance sheet of Bharti Airtel. So these are the, I think, bit easy things if you focus more on understanding a competition. The third sector which I right now bullish on uh, is a platform as a whole. Different platforms are there. I keep on studying whatever platforms I can study, and then there is like more of a stock specific approach. I don't go very in depth into the sectors. Like the fourth could be real estate, and like the allied construction kind of a things, or you can say capital goods also. I think it can be a good wealth creator in next 2 to 3 years, as I feel the capital cycle is just starting. And then building or construction, what you can say, the materials also looks bit bit right now, the valuation wise also it's a good valuation sector. So these are the generally 4 or 5 sectors which I look for. But again, in most of the cases, I generally go with the very stock specific approach, not widely as a sectorial approach, which I take generally into pharma or chemicals. So in chemical and pharma also, it's more of a stock specific approach. I'm not saying like if the chemical sector will do well, all the stocks in the chemical sector will do well. It is not possible. Few of them will do well, and the few other may not be, depending on what product, what competency, what process and management and capital allocation they have. So I think these are the generally 4 or 5 sectors which I generally look for. I started reading more about the electric vehicles also, but what I feel is electric vehicles is the story of electric vehicles may not be that easy, because wherever there is a growth, there will be a big disruption also. If the sector or if the company has not created any what you can say high entry barriers. So for example, Sonagoms are, so they are into the motors, electric motors. So again, you have to think about the product, like can they create some motors which other competitor cannot? Or another example could be battery manufacturing technology. So some players like Neogen Chemicals are like putting up some capex or starting with the pilot plant, and they are saying like we have certain competency into it. So you have to keep asking, I think, a question that what are stocks I'm researching or invested into, can my competitor jump into my circle, and can they disrupt me? So in case of electric vehicles, I think it might be a very difficult space to create wealth. Like OEMs, I don't think any OEM have significant what you can say pricing power or entry barriers. You know what is happening right now with the Maruti. uh, so that is I'm not very sure about that space, but definitely if you understand the supply chain or a value chain of that particular industry, like let's take an example of electric vehicles. So electric vehicles, if you check, firstly, what is the difference between normal IC engine vehicle and electric vehicle, is what are the important components into it. So one thing is a battery, one thing, another thing would be the electric motor, the third thing would be motor controller, and then more or less I think the tires and other things remain same as IC engine. So in these particular 3 4 components, we have to study and understand the competition. And I am not in a favor of investing into OEMs, because they generally don't have any pricing power, neither they have any entry barriers. So I generally stay away from investing into any OEMs, and I generally look forward to understand more about those sectors or those basically businesses which have created a high entry barriers, plus there should be a growth. Because if the sector or if the business only has created a and high entry barriers, but there is not much of a growth, still that doesn't create any value or any basically wealth, I think, in a longer term. So for example, would be the cigarette segment, the in which ITC is into. So definitely it's a high entry barrier segment. Anyone cannot easily enter into what you can say the regulated tobacco segment. But the growth seems to be bit the growth is not there much. So that's why you can see the valuations which market gives. So I think the wealth creation is a process which depends on multiple levers. Maybe starts with what entry barriers that segment or sector have, then what growth that sector can do, plus how long that moat can remain. Today I think there is a moat, but can it stay for next 3 or 5 or 10 years, and how long that growth can also sustain. So today, if the company which I have invested into is say probably growing at 20% or 25%, but after 5 years, can it grow by the same speed or same uh, maybe growth rate of 20%? So plus then it depends more of a how much basically the returns the investors can get on a incrementally invested capital. So the investor who invests on a day one or a year one has different what you can say the expectations compared to the investor who invests at the end of the fifth year. So plus at the end, at what price I'm buying. So I think these are the some factors which I look when I construct a portfolio.
Thanks for that, Shashank. So I'm going to pull back a little to when you were talking about chemicals and how you were classifying chemicals into bulk chemicals and specialty chemicals. Um, Specialty chemicals seems to be quite a trend and has been for quite a few years. But in the market situation we are in today, yes, bulk chemicals also are going through a lot of positives, but a lot of bulk chemicals manufacturers are getting classified as specialty chemicals, and the market isn't quite understanding the difference between specialty and bulk. So, could you share some thoughts on that and how one can differentiate between bulk and specialty, so to speak, and what to look out for?
Yeah, sure. So, like a basic definition of a specialty chemical is that if if suppose your final, let's assume a formulation or final product, let's assume it's a 10 kg product. Um uh, for that 10 kg final product, how much particular chemical is needed? Like let's assume to manufacture that 10 kg thing, you just need say 100 grams of some chemical. So in that opinion it might be a specialty, because and it should be a critical application. Even if suppose I don't add that 10 grams of some xyz chemical, my 10 kg product cannot come out with that required specification. So that is nothing but the specialty chemicals in a very simple language, I feel. But in market nowadays, what has started happening is investors or probably the companies are also telling the whatever we are manufacturing, it's a specialty thing. Actually it is not. Like last week only I was going through some of the investor presentation of one of the company, I won't name it. It was into dyes and related segment. So they have created a very good presentation and all. So one should actually understand what product they are into, what is the nature of the industry. If it is a commodity, it will at the end of the day will get the commodity kind of a valuations. but if they are actually in commodity and then you feel it's a specialty, and if you are buying at when the raw material prices are actually not raw material, maybe final product prices are actually at top end, and then if the down cycle comes, then it might be very difficult, to create a good wealth out of it. Like for example, in case of IOL chemicals, so they are into a product called as ibuprofen. It's a commodity product. So if you buy that stock when the ibuprofen prices are high, and then you think that the the growth will continue. If you check, when the ibuprofen prices were high, the IOL chemicals, I think, had a very good ROC, very good margins, very good profitability. But at the end of the day, it's a commodity chemical or a commodity product. So you see, you might have seen what has happened to the stock price, and it will go through these cycles until and unless they don't diversify into more stable products, or their revenues don't get diversified with other chemicals, and then might be they might enter into cramps that we don't know. But if you think of that business today, it's more of a commodity business, which is dependent on the ibuprofen, that too on a spot basis. So I think you have to give the valuations accordingly, and I think market is always very smart compared to as an individual investors. Market probably gives the most of the time right valuations, to by understanding the nature of the industry, depending on if it is a commodity or if it is specialty. So as I mentioned initially, like specialty chemicals are those chemicals which basically are very high value chemicals, and the quantity required for the application might be very very small. So it's a high value low volume kind of a game, uh, which generally specialty are into. I think specialty, that is one probably definition. Another thing which I personally feel is a specialty, maybe like something called as a poshak. So if you check the process into a forgination or to manufacture a forging, the process is not that difficult. The process might be easy, like it's a combination of, I think, chlorine and carbon monoxide. But uh, due to regulation, it became, I think, a specialty. So these other terms also one should understand, and then probably take a call. If the process is very easy and then there are no entry barriers, and plus like the capacities which China can produce, and if you're not able to compete with China, then it becomes difficult. So I think one should avoid that kind of a investing at any valuation. So I think that differentiation initially is very important before taking any investment decision, in at least into chemicals.
Fair enough. Thank you for that explanation. Um, Again, going on the chemicals side, what you talked about, what are something you avoid in chemical companies? For example, like I would have guessed, like say a company like Poshak, which is into hazardous chemistry. Would that be clearly that? I guess that wouldn't be too big of a risk because they've managed it well. But like for a lot of people, it would be a deterrent because if the phosgenation goes wrong or if something goes wrong, um, I mean, it deters a lot of people. I feel like it's a key risk for a lot of people, but it could be looked at as an advantage when they have that core competence in that particular type of chemistry. But what I'm getting at is there something you look at? If would there be something in chemical companies that you would avoid? Are there any certain type of chemical companies that you would avoid?
Yeah, surely. So as you have given the example of Poshak, so I will tell you my understanding on it. So if you check the plant location of the Poshak, so it is situated somewhere in Gujarat, and within that campus there is, I think, their parent company, Alembic Limited. They also have the plant. So and we are aware that what has happened during Bhopal crisis, that if there is some mismanagement, or if that gas leaks out, then it causes really terrible effects. So my basic understanding is, can a company able to basically afford, if my smaller company uh, leaks some gas, and then that actually affects the bigger company revenues. So I think promoters have a very good understanding about it. And in case of Poshak, they are started I think in 1986 with this forgination, and they have a good experience about 35 years or so. So definitely it's a product based risk. If something happens to forging as a chemical, if there is some replacement, then there might be a risk. But I think on a management side, or on a safety standards, till now I don't think there something very big has happened. So, and that's what actually gives them the entry barrier. So that is about the Poshak. Coming back to your question, what is the avoid chemicals? uh, so first and very simple things to avoid in the chemical sector is don't buy a commodity chemicals at the valuations of specialty, which is actually happening right now in the market. So don't buy 10 times sales, or maybe 7 8 times sales, price to sales for a commodity kind of a chemical. So that is the first like avoid signal for me. If you understand a bit of a chemical and the cycles, if it is a commodity, then if you're okay with the cyclical investing, then wait for your valuations and then only buy. Like probably if you are interested into IOLCP, if you think the company management everything is good, then wait for that cycle to come down, and then probably you can invest. I personally don't have any position into IOL, because I generally don't go with the commodity as a chemical. Then I think at the another end, like I think one should not buy any specialty company at any valuation, which might be the case with the Clean Sciences. So Clean Sciences as a company, it's an excellent company. Uh, if you check the promoters, I feel they are very very good promoters, technocrats. Products are also I think excellent products. Process innovation is there. Plus they are putting up some capex as well. But if you check the valuations, I think valuations are too high. I mean, I cannot probably pay those valuations. So generally that is also avoid for me. So first thing is, like, don't buy the commodity at specialty chemicals price, and don't buy specialty chemicals at very absurd valuations. So that is also a second, what you can say, the avoid criteria for me while buying a chemical stocks. Third could be related to commodity only. Don't buy any chemical stocks which don't have any entry barriers. If the process to make or manufacture that chemistry is very easy, and every Tom, Dick, and Harry can enter into that business without much of a struggle, then finally it doesn't make any sense for me, at least, to buy that particular chemical. Just to give some background on a chemical companies, if you check, chemical companies or investing into chemical as a sector is not investing into any metal stock, or investing into any auto manufacturing company. So every company is different, and one should really understand the process, and a bit of a chemical background or bit of a chemical knowledge one should have. Like for example, Aarti Industries is very good into benzene, so one should at least understand some details of what is benzene, and what are the its downstream derivatives, how they are procuring the basic raw materials, and what are the multi-step things which they are doing in case of Aarti. If you check Navin Fluorine, it's a fluorination. It's a completely different thing compared to what Aarti is doing. If you understand the Aarti, you may not understand the Navin. But if you understand the Tata Steel, definitely you can understand the JSW or some other competitor into the metal sector. Same is the thing. If you understand the Maruti, I think it's quite easy to understand the Tata Motors or some other players, maybe Mahindra and others. But in chemicals, every chemistry, every particular business is different. Then Poshak is into phosgenation, Neogen Chemicals is into bromine, DMCZ is into sulfur chemistry. Then Fairchem and Fine Organics are into oleochemicals and nutraceuticals, for which I have uploaded one video today only on a Fairchem Organics. Then Privi or Oriental or Aromatics or SH Kelkar, they are into say flavors and fragrance. Then alkyl amines, Balaji amines are into amine sector. Deepak Nitrite have a very good again on process efficiency and capability on a on a phenol and acetone side. Clean sciences have a very good again as I mentioned the chemistry on a green chemistry side where there is a very less effluents and the cost to treat those effluents is again like very low. PI Industries is very good player into CRAMS on agrochemical side. Heranba Industries is also into pyrethroids. So understanding the chemistry, I think, is very important, and then only you can take some calls based out of basically what understanding overall you have on that particular business or some related businesses which are working into that particular chemistry. Like for example, in case of the fluorination, in Navin Fluorine is there, SRF, some part of SRF is there, or Gujarat Fluorochemicals is there. Then you can pick out of those three which stock basically you think is doing bit better compared to others. So that is about more of a chemical as a industry, and generally which type of chemical stocks I generally avoid.
That's very interesting, Shashank. I think you've added a whole lot of detail there. My question, you explained some of the competitive advantages of someone like Poshak. But in today's video that you put out, which I've also pinned up for uh, the other people to have a look at, you also spoke about Solara and Fairchem. So how do you look at them both from a competitive, uh, advantage and growth perspective for the next 3 to 4 years?
Right. Yeah. So I will go one by one. Probably I will go with the Fairchem first and then the Solara. So if you check in case of the Fairchem, so the guys who have not watched the video, please watch it to have a better understanding. So in case of Fairchem Organics, they are actually into two segments. First segment is the oleochemicals and second one is the nutraceuticals. So if you check on a oleochemical side, so oleochemicals are basically those chemicals which are not derived from the crude, or they are not petrochemicals. So basically they are manufactured by the some what you can say the commodities like soya, sunflower, or maybe rice bran and different oils. Basically when they are manufactured, uh, the Fairchem Organics gets some byproducts, or probably you can call it a waste products while manufacturing the vegetable oils, edible oils, and from that they are deriving the various chemicals, and which are called as actually oleochemicals. So the entry barriers into this segment is basically the procurement process. So I think that also I have given some introduction in a video. I will repeat that again. So problem into this oleochemicals as a sector is that when any refinery, vegetable oil refinery, process these various stuffs like soya or a soybean or cotton seeds and different other things, uh, they don't have any specifications while processing it. So so companies like Fairchem Organics gets these raw materials without any specifications, while they have to deliver the final product for the clients like or customers like Asian Paints or some other customers like Cargill or BASF at very particular, what you can say, at particular specification. So that is basically their niche, and that is I think the entry barrier which they have created, so that others generally don't able to enter into these segments. So that is I think about the Fairchem, and I think Fairchem is the only producer or manufacturer in India which have that particular technology and a competency at that scale. If you check, I think again I have mentioned in today's video, so that company started in 1996-97 with about 3,000 metric ton raw material processing capacity. And if you check today, after about 23-24 years, right now they have about 1,20,000 capacity which is upcoming. Probably it will get completed at the end of the year 2022 financial year. Right now they have about I think 90,000 metric ton processing capacity, raw material processing capacity. Just to add one point, this capacity is always calculated in terms of raw material processing, not the final outcome or final output what they are manufacturing out of it, because that depends a lot based on what type of a raw material or what quality raw material they are getting. So generally they calculate in these terms. So I think by procurement and by developing that particular process, they have got some particular machineries from out of India, and after a lot of what you can say trial and error, they have developed these capacities and these processes, which is probably a bit difficult for others to enter into this segment. So that is, I think, about the Fairchem Organics. The another is about the Solara, which I think you also asked a question on. So Solara, if you can check, so it's a similar thing like IOL chemicals, where the key product is, let's say, ibuprofen, which is a complete commodity chemical, and they have a bit higher dependency on ibuprofen. And see, as I was mentioning, markets are very smart. Market is giving a different valuations to Solara, and let's assume to Fairchem Organics and Poshak, and probably Clean Sciences. So you can just check the valuations in any method you think is right, probably price to earnings or EV to EBITDA, or any matrix you use. Probably you will see Solara is trading at very low valuations, while Poshak and Clean Sciences are trading at very high valuations. So the reason is basically the chemistry behind it. So if you can check in the case of Solara, as I mentioned, they are more into ibuprofen side. Only good point of a Solara compared to IOL chemicals on ibuprofen is that they are basically into long-term contracts, and Solara is also into ibuprofen chemistry from last about 3 decades. So they have the long-term contracts, so that actually helps when the market of ibuprofen goes down. So they don't have to sell at very low prices, which is the case with the IOLCP right now. If you check the last quarter, so Solara profitability also gone down, but there was a big hit on if you check on a IOL chemicals side. Why I am bit interested on a Solara side is basically like we always have to understand what is going to happen in a business in next about 3 to 5 years. If you think like uh, the business going to remain what it is today, then there is, I think, I'm not interested into investing into Solara. But if you check like what's going to happen in next 3 to 5 years, I think it's a very interesting business, because if you check some other molecules which Solara has been filing for last about 2 to 3 years, they are a bit difficult to manufacture, and they are a bit complex as well. And there is a very less competition into those molecules which are apart from the ibuprofen and gabapentin, or very commoditized kind of a molecules. Uh, so that is a one reason. Second reason could be Solara is also going very aggressive, I feel, on a cram side. So uh, so uh, so if you check on a cram side, they have going to merge another company called as Auror. So they also have a small portfolio on a cram side. Plus they are planning about a one acquisition in a west. So basically, if you check crams as a business, then that business particularly needs a lot of time to develop the, what you can say, the the brand name, or you have to deliver that quality, and you have to deliver that quality consistently. So it takes a lot of time. So if you actually acquire some well-known name, maybe a small player who have good relations with their customers or clients, and then you just have to manufacture that particular product in India, uh, based on basically their competency and their process. So that's what I think Solara probably will be doing in the future. If they able to execute it, I think there will be good re-rating. Right now the stock is I think available at very decent valuations. And another key aspect, I will come back to the commodity side of a Solara, is how well you execute. because product is definitely a commodity product, but I think the management is a tremendous management in a Solara. Till now they have done very good execution. I think 24% EBITDA margins in ibuprofen or very commodity business is very difficult. Another example, I will just compare it with the Hikal. So Hikal also, I don't think they have such a high margins. Probably they started improving it recently from last I think 3 4 quarters. But if you check on a Solara side, gross margins are about 53 54%. And if you understand the Hikal business, it's more of a crams business. So still Solara has done, I think, a very good job. And I feel if they able to execute the cram side very well in a future about next say 5 years, uh, then I think the EBITDA margins, which are about 23 24% today, might reach to 27 28 also. We have to see how the management able to execute it. Right now, Aditya Puri also, I think, has joined as a chairman on a Solara. So it's an interesting company. Right now it's a commodity. We have to keep tracking, and then you have to build the value, the portfolio weightage as and when they execute it. But I think I am positive on it, and I like the management. I If you check the management history, there are quite a like couple, at least couple of good people. Maybe others, some others might be more, but on a management side and incremental things, what going to happen in Solara looks interesting, at least right now, with the valuations also.
So you briefly spoke about Hikal as well. It seems to be, one of the companies that is very much poised to do well over the next period. Although its advantages are very different because of the fact that they are able to get now these long term contracts, and because they are manufacturing on the and doing research on the behalf of other companies, their margins will tend to be a lot more stable. How do you see that competitive advantage playing out vis-a-vis the rest of the pharma industry?
Right. So if you check Hikal as a business or Hikal as a company, so it's a combination of, I think, three segments or three subsectors. First part is human pharma, second part is animal pharma, and third part is the agrochemical as a business. So these three businesses are completely different, that one should understand while studying a Hikal. Like for example, human pharma is a very big opportunity. So is the competition. So there is a huge competition on human pharma side. Second thing is animal pharma, which I feel is the best sector to be in, because there is a less competition. Opportunity size is not as big as human pharma, but I think competition is a bit limited. And third one is the agrochemical side, where again a competition is bit limited, but it's again a cyclical sector. uh, Depends on the monsoon. So I feel very good blend between agrochemicals and a human pharma is animal pharma, because animal pharma is not cyclical. There is a secular demand on animal pharma side, plus there are good margins, and plus there is a less competition. So I think Hikal have all three together. In future, probably they were mentioning in a con call they will launch a separate segment on an animal pharma side. So let's see how it goes. Till now, I think the management has done okay. It's not very great, but if you check from last 2 3 quarters, the margins are very stable. They started improving the margins also. So I think it looks very good in future. As I mentioned earlier, we have to think about the future, not what is available today. So I think next couple of years, probably 3 4 years, if they do the very good basically execution, which they are like, if you check their capex which they have planned, I think 300 crores each year, about 600 crores capex they will be doing in next I think 2 3 years. So if they able to execute that well, if the earning expansion starts, which I think already started, it looks it's a promising business, and they have entered and got the long term contracts on a animal pharma side as well. So I think it also looks a interesting business right now.
So Shashank, you'd mentioned how you're bullish on animal pharma. Another name that comes to mind is Sequent, and you have been tracking it as well. I guess they have been going through some headwinds with respect to their turkey business, and yeah, a few
Yeah,
other things. So, could you talk about Sequent also a little bit if you're comfortable?
yeah,
Also,
yeah,
just wanted to
definitely.
add a quick, just wanted to add a quick disclaimer. Nothing said here is investment advice, guys. Please do your own research. This is just for educational purposes. So yeah, please do your own research before investing and consult your own financial advisor. Sorry, Shashank. Go ahead.
Yeah, so I just also wanted to mention it again. So whatever stocks we are discussing here is not a financial advice, and you will be responsible whatever positions you will be taking or not taking. Here I just trying to discuss some stocks so that like I will relate what are the different terminologies in chemical as well as on a pharma side, how different these chemicals or businesses are compared to their specific niche. Yeah, so let's come back to the Sequent. So, Sequent is basically a pure play animal pharma business. So, as I mentioned, like I think animal pharma as a business is a very good business. To understand more, one can study Zoetis, which is the number one company globally. So, on a Sequent side, let's discuss first what is happening right now and why the stock has came down probably about 300 rupees right now to maybe 160 or so. So yeah, as you mentioned that Turkish lira uh, is causing some headwinds for them. Uh, but if you check the dependency on a Turkish lira right now might be very less, about 10% of their revenues, I think. Uh, but one should also understand incrementally what can happen into this business, because opportunity size is again a very huge opportunity size. And Carlyle is basically there, who has taken a stake I think in 2020 if I'm right. And as I started initially by saying that one should actually understand the competition when you invest in any particular company. So I think competition in a animal pharma side is probably very low compared to human pharma. So I think that is a long term advantage or long term, what you can say, benefit this industry is probably go through. And with respect to that, what Sequent has done in last, say, after 2018, when that demerger happened between Solara with Solara and Sequent, separate companies, pure play human pharma and pure play animal pharma. So I think these things on a competition side remain same right now. Definitely the business is going through some headwinds. First thing is basically the Turkish lira. Second thing, and more importantly, is they have some dependency on China for a raw materials procurement. But what I feel, in this business there is a significant operating leverage can play in a longer term. uh, uh, and if they able to execute well, recently they have done one acquisition in a Brazil side. And in animal pharma again there are two sub segments. One is the production animals, and second one is the basically companion animals or pet segment. So if you check the recent trends, what has happened into the pet segment after COVID, so definitely the vet visits has increased, and probably the expenditure on pets has also increased. So the question is, ca- if you let's assume for next 5 or 10 years, can my affection or the care for my dog or my cat will reduce, even if there is a let's assume very high improvement in a technological sector, or some other things which I think might have very high disruption. Like I don't know what's going to happen on a technological side, because it's a high growing industry and high disruptive industry. But if you stick to the very basic things like probably Warren Buffett has invested into Coke in 1980s, that it's a FMCG kind of a business. So is, I think, the animal pharma. First thing is the meat production, meat consumption may not go down. Definitely, there has been a lab-based meats which is into flavor right now. But another thing is about the pet animals. So I think it's a long-term trend, and if you get a company at discount compared to what it was before 6 months, I think it looks interesting. Depends a lot on the execution side, which I think they will able to do. So like I am at least positive on a Sequent, because I think it's a headwind for probably next couple of quarters, and the things should get settled down after that. Because if you check some other initiative the company has taken, they started focusing on a pet segment. They started focusing more on injectables, sterile injectables, which is a high gross margin or high margin business. And like I think until unless Carlyle is there, I am quite positive about this business.
Thanks for that. Thanks for clarifying that, Shashank. So I'm going to go back to something you said about management a little earlier. So, how does one assess management from the retail standpoint? Say you're not an institution or you can't physically meet the management or get on a call. Um, how does one assess the management, and is there anything you look for in particular when with respect to management? And what are some deal breakers for you, like absolute no nos? Like what
Right.
will? Yeah, go ahead.
uh, yeah, so basically I look for the two things when I try to understand the management. First thing is, what is their history on a capital allocation side, where they basically with the minority shareholders, or basically they were thinking in their own, basically for their own benefit. So capital allocation means like what incrementally capital they are putting into their business or taking out of their business. What is their dividend policy? At what price generally they are doing a buyback? So I don't want to name particular companies, but there was a company, probably I think in 2018 or 19, which bought back their shares at 5,500, and it was a commodity based company. And the stock price has came down, I think after that, during COVID, about 500-600 rupees. Definitely that price buyback was not justified at all. And first negative sign was like when promoters actually also participate into the buybacks. So I think that is a negative sign. And then one should also try to understand what are the related party transactions which they have. And if it is a bad capital allocation, then generally I try to avoid, or at least I will give some, you can say, some time to understand more about that company. Because generally what happens with most of the companies is like the management will give you very rosy pictures that will able to grow 30%, 25%, 40% year on year for next 2 3 years. And the key or second part of understanding a management is execution. So for retail investors, I think, like, who probably don't have any access to management, they cannot visit the plant, they cannot probably do any more scuttle. But you look for a history. History is very good, I think, indication. If management is consistently doing whatever they are saying, then I think it's a good check to understand more about the management. And uh, like, we have to accept that uh, for every management, it's a shades of gray. So you have to take like what shade of gray you are comfortable with. I don't think there is a white shade which is available, at least in India, probably after excluding some of the very big groups. And definitely, I'm not comfortable with going with the black color. So I have my, what you can say, own shade of gray which I'm comfortable with, which is not probably I mean the cleanest one. But I think we have to sacrifice a bit when, because you won't get everything clean. So like it depends on how much you can accept. Uh, but on a execution side and capital allocation side, I think those are the very important matrices which one should not neglect. If management is keep on giving me rosy pictures, and if they are not able to execute it, it's a clear no for me. I mean, I won't ever invest into that particular stock.
All right, all right. Thank you for clarifying that. So I'm gonna move on to a question about pharma, basic pharma for the retail. Who After which I'll move on to more philosophical questions. But for a newbie, say for a newbie, a lot of people don't understand pharma, so they stay away from it. But I guess maybe from my own standpoint, I can say that I was uh, I was of that belief that it doesn't fit my circle of competence, so I'll stay away from it till I realize it's actually not that hard to understand if you dedicate some hours to understanding the pharma industry. So, where does a newbie start with respect to his uh, to understand pharma, and where does he start with his research, his or her research?
Right. Yeah, so I will just give a very brief introduction about pharma. I am also learning a pharma. So there are in generally two to three segments. If you have a broader, if you want to understand it broadly. So one thing is the formulation based players, and another part is CRAMS or API manufacturers. So just to give the value chain. So if you check any pharma product, it starts generally with the very basic raw materials called as the key starting materials. After that, intermediates comes. After that, API, active pharmaceutical ingredient, comes, and the last part is the formulation. I will explain it with some example. Let's take a very simple example of paracetamol. So paracetamol we take when we have a flu or fever or any pain or something. So it's a reliever also. So the very basic material to manufacture the paracetamol is some derivative of a crude. So so it is called as a PNCB, paranitochlorobenzene. That is a chemical. Then forward integration for that PNCB is PAP, that is paraminophenol, and the last product is a paracetamol. So to understand the pharma sector, one should really understand what are the complete supply chain or the value chains in terms of the bit of a technicalities. Because if you understand the manufacturers who are there for the PNCB, who are there for a PAP, and finally who are manufacturing the final product, which is paracetamol, I think it will be very easier for you to understand the whole industry. Because if you check generally on a formulation side, these big companies like Sun Pharma or a Lupin or some other companies like Aurobindo Pharma, so so creating a formulation, I think it's not very difficult thing. You have to take a API, you have to add some excipients, you have to brand it, and maybe like unbranded also you can sell. So that is, I don't think, is a very complex thing. It's more of a commodity kind of a thing. These companies got early what you can say, early entrants advantage, and they have minted money for last 15-20 years, which is not the case right now. uh, Second thing is about the API, which is actually a salt of that particular medicine, or that is the active ingredient in that medicine. uh, so in APIs also, various types of APIs are there. Some of them are the commodity APIs, some of them are the complex APIs, some of them are also like specifically manufactured for certain innovators. So that is what is the cramps kind of a play. So this is generally a very basic overview of a pharma sector. Now the question which you asked me, like how one should understand the pharma as a sector who is just starting to understand this industry. So I feel, as I initially mentioned, it's not like understanding a metal sector, because for a metal sector, what price Tata Steel will have for its steel product, more or less similar price will have for the JSW, because at the end both companies will be manufacturing steel only. But in case of pharma, it completely depends on what products they have, and every company have their basically product portfolio which is not the exact clone of their competitors. So lot will depend on what kind of products they have or what kind of product portfolio they have. Do they have the any specific agreements or any specific manufacturing agreements with innovators or some other players, or they are only into commodity type of APIs? So that one should understand, and one have to do bit, I think, more research when you go for a pharma company, because it's a sector within a sector. Every company is kind of a sector or so, which is not the case with some other probably sectors. So one very good resource which is available for us as a retail investor is con calls. I mean, on a day one you won't able to understand everything clean and clear, but you have to develop that habit of reading the con calls or listening to the con calls. So when I started understanding about the pharma, I also didn't knew anything about these terms and these terminologies, but I kept on reading about the different con calls. And when you complete one company con call, you will feel that whatever they are doing is an excellent thing. But that is not the case. You will understand the pharma as a sector when you'll at least study about 15-20 companies, and then you can take or maybe take a call to invest into one or two, because then actually you will come to know what is the process efficiency the X company have compared to Y. What is the difference between the complex generics and the commodity generics? What is actually a cramps means, or CDMO, CRO means? If any one of you have not watched my videos on YouTube, so I have created about 4 or 5 part series on YouTube for these all different terms. What is the cramps, what is the CRO, CDMO? There has been a one dedicated video for that. What is the different uh, differentiation between formulations, API, that I have explained in one video. There is a separate video which I created on a biologic side also. So from very basic terminologies I have explained there. Then there are certain terminologies like Gadufa or Padufa, that also you can check. So like in a very simple language, I try to explain over there. So one of the resources which we can use to understand pharma as an industry or a sector, I think, is a con call, and then definitely the annual reports are there. But you have to have go through those, like at least last 5 or 6 years con calls for every company whichever is providing you those details. So if you read 5 year con calls, like it is about 20 con calls, and you have to do that for at least 10-15 companies, then you will start understanding, and then you will start able to connecting the dots. It's more of a, I think, connecting the dots from one company, from one product to another product. You have to understand the complete value chain. Like for example, in case of paracetamol, so for example, granules. Let me take some example. I think it will be better to understand. So granules, if it is manufacturing the paracetamol, you have to check if they are manufacturing the raw materials for them. So raw material, as I mentioned earlier, it is a para-aminophenol, which is nothing but the chemical. So if you check right now, the condition for the granules is that the para-aminophenol prices has increased a lot because of the high demand, and then there was a supply disruption in a global basis, because there was a one company from China, Bai Chemicals, Anhui Bai Chemicals. They actually had a shutdown in their facility. But right now granules don't have any backward integration with them, so they are facing a bit of a headwinds, and which actually affected their financials as well. So if you can understand this chemistry and bit of a process side, so let me go a bit deeper into it. uh, I'll make it a bit clearer. So para-aminophenol have basically two processes by which it can be manufactured. One is, which I explained earlier, which is from the PNCB route, which is with effluents. So there are various effluents which get, you can say, manufactured or comes out with the final product. So OAP is orthoaminophenol is what you can say another material which comes out with para-aminophenol when you process the para-nitrochlorobenzene. So to treat these effluents, you need a separate cost. Orthominophenol, definitely you can sell it in a market, but there are some other effluent which are not required. You have to treat them. You cannot just directly dispose of like what China was doing earlier. So you need to have some liquid discharge plants and all. Uh, but let's assume a company which have a specific process by which they just avoid the effluents, or by that process there is zero effluents which is generally getting created. So there is another process, if you check, which is by which you can create the para-aminophenol, uh, that is called as from nitrobenzene route. So if you check the nitrobenzene route, then that route don't have any effluents. So that is a bit on a more on a technical side. So if you can understand this, definitely it helps a lot. But definitely it doesn't comes on a day one, and it's a process. I also didn't knew all about this when I started learning about the pharma, but one should have that persistence and I mean, sticking with the problem. I think that's what is a more important when you at least do some research on a equity side. So the knowledge, I think you develops over the period of time, and start with con calls, start with annual reports, start with the live con calls. Prepare your questionnaire, ask it to the management. I think managements are kind enough to to reply to it. So that is the simple process which I follow, and I think I would recommend others also can and follow. And then the later part is, then you start visiting uh, the plants. You develop your circle. You start asking various questions within your circle, like whoever have some understanding into chemical side, or develop some contacts who have actually some of the chemical plants which I mean, I generally ask in my circle, like what is the status on ground right now, what are the different prices of the chemicals, or what is actually happening with the China plus one. Are you seeing anything on the ground? So that comes later. But I think this following a con calls and following a annual reports, I think, is a very good start for any like a new investor or a analyst.
So, Shashank, thank you for that in depth explanation. So, I'll move on to a few more general questions, and I'll club them together because quite a few people have questions. So, we do an audience Q&A after. So, I'll just club these two questions together. So, what are three do's and what are three don'ts for beginner investors? And the second question is, what are your favorite investment books?
Yeah, sure. So let me start with the don'ts. I think that is more important rather than what are the do's. So I think first thing, one should be very clear that we should not speculate. So there are many speculators, intraday traders. I don't go with that club, because that is a highly risky thing. We are using a leverage. Generally, my only advice is for the newcomer or a new investor or newcomer to the market is, don't ever touch to FNO. So that is a highly risky thing. If you can avoid it, if you can basically avoid your capital uh, to become zero for initial 2 3 years, I think you have achieved a very significant achievement initially. So don't fall for these traps of getting into FNO, getting into leverage, getting into tips. Don't believe in tips. Do your own understanding, own research. Don't even believe on me. whenever you have your own understanding and own, what you can say, the competence, I think you'll learn a lot and you'll avoid the mistakes. Second thing is again related to first one, like don't directly clone these big investors portfolio, because that guy is not going to tell you when he is going to exit. So definitely you take the ideas from the big investors, understand their philosophy, their process by which they are basically shortlisting or investing. Try to understand more of like what stocks they have invested into, but directly don't clone it, because it, I mean, I have seen in my journey that most of the retail investors directly clone what any XYZ big investor invest into, and then they don't know like what to do later. It's like a Abhimanyu kind of a story. They know how to enter into the Chakravyuha, but they don't know how to come out of it. So my humble request is like, don't directly clone anyone's basically portfolios, because everyone will tell you when they are entering, no one will tell you when they are exiting. So don't go for that. And basically don't take any decisions of investing or not investing into any particular stock by just looking at the price, because until and unless you don't understand the business behind it, I don't think there is any value into looking at the price. Once you understand the business, the management, the competition, and various aspects of it, I think then it makes a lot of sense to know about the price. And then, for example, if you invested at say 100 rupees and the stock has gone to say 70 rupees, but you think the business is very good, competition is very less, management is doing excellent execution, I think 70 rupees must be the good price and you should be happy, rather than becoming sad when the stock comes at 70. But for that, you need to have these all other understanding, which you definitely cannot get by just looking at the price. And basically, like, these are generally, I would say, the three don'ts which a newcomer can basically follow. Then I think you have asked about three do's also. So very simple practice which any new investor can follow is, you should have the long term vision, because like, and understand the power of compounding. So power of compounding is really a very very big force, or as a you can say a concept. Like, just for example, for new investors who are looking to join or invest in markets, like, if you if you can able to compound your money by 25%, with 3 years you basically double in 3 years. If you able to do it for 10 years, you make your investment about 10 times. So whatever 1 rupee you are invested today would be 10 rupees in 10 years. But actual fun part, or you can say the force of this compounding, starts after first 10th year probably. So for from 11th year to 20th year, you actually don't make from 10 rupees to 20 rupees. So whatever you are invested on a day one or year one is 1 rupee, on a end of the 10th year it is 10 rupee with 25% CAGR. On the end At the end of the 20th year, it is not 20x, but it is 100x. And at the end of the 30 year is not 30x, it is 1000x. So that is the power of compounding. It's very difficult to generate 25% CAGR, but even if someone does it for like say 16 to 18% for a very long period of time, I think it's a excellent concept, and one should understand it very early in a life. A lot of us actually focuses more on how much returns, or as a percentage returns I can deliver. I think one should focus more on a longevity side. So I was talking to one of the, I think, a investor, or maybe you can call it as a YouTuber. Um, So he's like what 15, 16 years old. I just had a conversation last week with him. I mean, I got fascinated with his interest and uh, his understanding at that age. Like he was, I think, at ninth standard probably. So he is making some videos on some of the stocks, and very very good explanation. Like at ninth standard, I didn't knew anything about the markets probably, like except watching the stock prices. So have a very good vision. And if that person is there, I just forgot his name, like was an ninth standard probably at 14, 15 age. So he have at least next 60 years with him, like 50 to 60 years. So even if you invest in index funds and able to compound at what 13, 14, 15%, I think you will create a huge wealth at the age of 60 or probably 65. So so one should focus more on a longevity side compared to what returns we can make. Definitely we have to strive for making some alpha compared to index, but I think first goal is to stay invested at all times for a long period of time. That's what I think would be first do, I think. I can tell. Second would be, I think, one should have the very independent thinking. One should not depend a lot based on what others are thinking. Like what you think is right, probably you should go for it. And like should not get pressurized by some influencers, some others. So that is what I think would be the second do. And third and very very important, or the most important, is one should keep reading. There is a one quote by someone that the person who don't read don't have any advantage over the person who can't read. So I think you should and must keep reading whatever you can, uh, on a con call side or on a annual report side, on a magazines, newspapers, and more data crunching thing. And over the period of time, I think you'll have a very good understanding of that sector and that business, and it will become very easy for you to take decision to get into the stock or get out of the stock. So I think these would be my three do's and three don'ts for any new investor or even a seasoned one probably. Because reading is that you have to start from a day one, from when you investing start investing, and you have to keep on following the process and keep on reading until and unless like you are there into the markets. uh, you have asked me about three books.
Yeah, I
So
guess it just ties in whatever your favorite investment books are with your last point about reading.
yeah, yeah. uh, yeah, so I will start with the very very simple books initially. Like Peter Lynch, all three books are very good. One Upon Wall Street, Learn and On, and these books you can start with, very easy books to understand. Common Stocks and Common Profit by Philip Fisher is also a very good book. It actually tells you what scuttlebutt is, what are the different things one should look for. And I think he was a very good investor, more of a on a growth side. Generally we all learn from a Warren Buffett, and we generally like I think spend a lot of time into value investing, which actually I mean, the investor have the misconception that the buying at low P is a value investing, which I don't generally agree with. One should actually understand what is the quality of a business which you are buying, and like what is the opportunity size into that particular segment, and then how the management is executing that. Because more often than not, market knows more compared to a single individual investors. And according to that, the market gives the valuations. Until and unless there is a complete crash which has happened into the COVID time in 2020 March, and everything falls off, then it's fine. Like you can get very high quality businesses at very cheap valuations. But that is not the case always. Market is most of the time smarter than the individual investors, and that's why don't look for very low P stocks until and unless you are a cyclical investors, and you know what you're doing, right? Cyclical investing is a completely different part, and it is, you need to have that competency with you. Like, you cannot just buy anything, like for example, you buy a safe like Nestle or HUL or Asian Paints, and let's say you hold it for next 5 years, probably you will make something out of it because the demand is secular, the revenues and profitability is secular. But if you do the same thing with the Tata Steel or JSW Steel or some other aluminum manufacturer or some other commodity, completely commodity and cyclical type of investing, I don't think even in next 2 3 years you will able to recover. Similar is the case with the sugar kind of stock. So you need to understand what you are doing. If you don't understand, it's better you don't do it, or consult the better person who knows actually that thing. So these two books I will start with. Then there is a the one of the best book which I think is by the Michael Porter. Two books basically: Competitive Advantage and Competitive Strategy. These are the bit high level books. The language is not very easy to understand, but even if you understand just the Porter five forces in your investing career, I think it will give you the significant boost. And if then you will try to relate the different businesses with those Porter five forces, and actually it changes the whole ball game. At least it has done for me. So I generally look for every business in that lens, and probably generally only go invest or do like in-depth analysis wherever I think there is a monopoly duopoly kind of a structure, and you will get those opportunities. And probably before market, if you concentrate more on your circle of competence. Then couple of more books I'll tell you, like there is a very good book by Christopher Mayer, 100 to 1. So he has given the list of the 100 multi-baggers in US markets. So you can read about it and then try to apply similar frameworks in Indian markets. At least the frameworks won't be exactly same, but you will learn a lot out of it. So that is the another book. And there is another one more book which I will recommend is the Capital Returns. So it's a good book to understand more of how the capital cycle works. So these are the 3 4 books I think would be uh, can be a good start for a new investor.
Thanks, Shashank, for an elaborate list. Guys, we're gonna start with the audience Q and A. Before we start with the audience Q and A, I just want to reiterate: nothing said here is investment advice. Please do your own research and consult your own financial advisor. And before we start the Q and A, please follow Shashank on Twitter at at Value Educator. That's at VALUE Educator, and he goes by the same name on YouTube. He's got a fairly big following on YouTube with a very good channel with a lot of great insights. So you must check out his channel on YouTube. So yeah, now I'm just gonna start pulling up people. Anything else, Shashank, you'd like to add?
I think we can start with the Q&A, and then whatever will be the questions. I mean, I'm open to answer them.
Shiv, go ahead, man.
Yeah, hi, Sashank. Thank you so much. Your YouTube channel is an immense, powerhouse for knowledge. Uh, in starting, you told that you are following up, 4 5 sectors, in which one of them was platform sectors. Uh, can you elaborate more on that? Which are the sectors and the kind of stocks which you are looking to this, and what are the criterias we have to look into that?
Okay. Thank you, Shiv, for your question. So, in case of platforms, I think it's again understanding of that particular service which you should, I think, understand. And platforms, I think, is bit different compared to the normal IT company. So I feel normal IT company as good as a commodity kind of a business. But if you check the platforms, they are very focused. Like for example, IEX. So IEX is only competent into the power trading. They are not going into any commodity trading or any other type of trading. Same is the case with say CDSL or MCX or some other platforms like CAMS or say Zomato or like these are just examples I'm giving. I'm not saying like they are good or bad, but if you just relate that particular service with their, say, the margins, like in the case of IEX, so operating margins are about more than 85%, and then one should try to understand what are the reasons behind it. So I feel once you able to do or create a good platform, then network effect will start kicking in. So for example, very simple example I will give. uh, let's say you are there on a Facebook. So as you are there on a Facebook, your family will also wanted to be on a Facebook, or your friends also will wanted to be a Facebook. And it's a reverse also. Just because your friend and your relatives are on the Facebook, you wanted to join a Facebook, right? The thing is like how much incremental cost Facebook has to occur, uh, just to add you or your family or your relatives on a Facebook. So I think that is a very very small incremental cost, probably nil. So that is how I think the operating leverage starts kicking in. Same is the case with the IEX, same is the case with some other platforms. So incremental expenses, I think, probably are nil, and that's why the margins keeps expanding. They have to just complete those transactions. And if the final demand is secular, which I feel is in a power sector at least, definitely. And if there are high entry barriers, uh, uh, the that platform can keep doing very well. Same is the case with the Google, same is the case with Amazon. These are the very very big giant platforms. If you check the top 10 list of the market capitalization in whole world, I think it will be dominated with the platform companies. So I think that trend has just started in India. And if you have the good companies, if you can pick them earlier, I think there is a good runaway ahead.
Thank you so much, Shashank. Wish you a happy new year. Thank you so much.
Thank you, I wish you a happy new year too.
AI, go ahead, man. Hope all's well.
Yeah, hi Shashank. Thanks for sharing your insights. I continuously follow your channel and your Twitter handle. Really insightful, and especially the video dedicated on books you have on your YouTube channel is awesome. Okay, I have a few questions I quickly ask and then I'll listen to you. Basically, the animal pharma in unregulated space. What are your views on that? Specifically for NGL, they don't want to focus on regulated markets. So, what's your take on that? And apart from that, as you were discussing economies of scale and operating leverage in case of platform business, so how you see this in pharma side?
Yeah, thank you for your question. So yeah, animal pharma, I feel regulated is good, but I think unregulated, I mean, it's a that market have some benefits, that market has some drawbacks. Benefit is basically you don't have those upfront cost, the which you have to occur while you are filing for the US FDA side. Right, so US FDA takes a good amount of fees for filing these applications, which is not the case in unregulated market, might be very low. uh, but the drawback is like the size of the opportunity. So size of the opportunity is also a bit less than regulated markets. Actually comes with the high entry barriers, which generally unregulated markets don't. So whoever is selling into a US market, generally, like, there might be lesser competition. So NGL cannot sell into US market because they don't have the US FDA approved plants, and for that they will need some more cost, so on and so forth. In case of NGL, I particularly is not invested into NGL, because not because they are into unregulated market. Another reason would be the affluent related issues. So I'm not that comfortable with it. So generally I will avoid it. But animal pharma as a whole, I think it's one of the very good sector. And if any company is able to scale and able to execute it, and probably have a good balance sheet, good capital allocation with the promoters, I think uh, there should not be any issue. But on a unregulated side, as I said, there are certain advantages, certain disadvantages. I'm not very sure about like how big is the opportunity compared to at least regulated. So I will generally go with the regulated players who have a good strong backing with the investors like Carlyle. So that right now most of the investors might be unhappy because of what is happening with stock. But if they able to execute, I think these trying times might be looked as a opportunity as well. And I think you have asked me on a second question related to platforms, uh, like how they are related with the pharma side. So you have to understand like in crams, if you read some of the con calls, in case of solar also you can read. So most of the management keeps saying the one thing that this is like the industry where you have to put up the plans first. You have to create a brand. You have to basically not brand probably, but you have to have that competency. No innovator going to give you their molecule straight away. It's a difficult process. It takes a time. But once you do that and you gain the trust of that innovator, then I think from that day onwards your operating leverage starts kicking in. And it's a case with any manufacturing company. Until and unless you don't have the competency to invest to to develop that molecule, till that like all the expenses will, you have to bear it. Same is the case with many companies, like example Laurus Lab. You know what has happened once that operating leverage started kicking in. You see the history of Laurus Lab from 2016 to 2000, about probably 19. So and after that, and it is happening right now also with many other companies. So if you are very sure about the management, if they able to execute it, I think that is the advantage for you as an investor. So another one more point I wanted to mention is that you have to keep asking yourself, do you know more than the market, or market knows probably more than you? And if you really think you know more than market, then I think the cases like these few which I mentioned earlier might be the very good opportunity for you to invest right now when whole market is negative about those companies. And it has happened in history also. The question is like how better you know about those companies.
Yeah, thank you, Shashank. And one small quick question, when we come to valuation, right? So when we discuss the parameters like EV by sales or EV upon EBIT, so these low deciles, when we consider, so how to go about considering these while evaluating a business? I mean, for a beginner's perspective.
Yeah, again a good question, but the answer is not very straightforward or a very simple answer, because uh, every business have particular niche or market values that business according to what domain they are into. Uh, so as I was mentioning earlier, the company who manufactures the commodity chemical versus the common company who manufactures the specialty chemical, or the company who manufacture or a seasoned player into crams or CDMO will get the different valuations. So it's not like you cannot put everything into a single bucket and assume that price to sales 2 or 3 times is a low value company, and price to sales 9 or 10 times is a high value company. I think you have to understand how the market re-rated that company over the last 5 to 10 years. If you check Aarti Industries, I think was at about 10 to 12 p in last in 2010 or 2011 12. Right now it is trading at significant higher valuation due to various reasons. So so understanding, I think valuation, to understand the valuation one should understand the business, not the vice versa. Like you can't start with the valuation first and then decide like this looks cheap or this looks expensive, so I'm not going to invest. Start with the business. Start studying similar type of businesses, like for example why Solara is getting low valuation, why Granules is getting low valuation, why Suven or DVs are getting very high valuations. So I think that should be the process, and then you decide with your multiples by studying the different businesses in that particular framework or that particular sub segment. May it be cramps, may it be commodity chemicals, may it be some companies which are transforming from the commodity to specialty too. So I think there will be, you will get different case studies and different examples if you look back for last about 10-year history in Indian markets.
Yeah, thanks, Ashank.
Yeah, thank you.
May I go ahead, Shahir?
Yeah, go ahead, man.
Yeah. Hi, Shashank. So I go by the screen name Skipper, and I'm into equity value investing as well. And I'm 33, and I'm kind of achieved financial independence right now. So I'm quite happy with it. The question I wanted to ask is more like your opinion about this ESG concerns that are there in the market actually. So like, is it really, are institutions genuinely concerned about ESG rating of a company, or is it just a facade, just to throw it and scare the retailers away? Does it? I mean, do these big investors really care about the ESG while valuating a company or like investing in a company?
Yeah, thanks for your question.
Yeah.
So I think ESG does matter in a long run, like because it also shows the character of a company. So environment and a governance I think are very important in any kind of a company. Environmental related thing is very important, at least into chemicals and pharma side. So how well those companies are treating their effluents actually I think really matters, because you know what has happened on a China side. And then many investors have asked me this question, that whatever has happened in a China in last 5 years, when government has asked them to move their plants out of a city, and when the production cost started increasing, and then Indian manufacturers got the advantage, and so on and so forth. Can that happen in India? So so I think understanding the environment, understand environmental related issues, understanding the governance of the company is important. And definitely the bigger players also are interested into it, and I think one should not skip it. If you have it, definitely it will be added advantage to you, I think.
I understand that, Shashank. I understand when a company responds to or like works towards improving its ESG rating or like tries to be more socially responsible. I understand that. But if you see, like, take the example of a chemical sector. Actually, like most of the chemical, like you mentioned earlier in this room, like some of those things can get hazardous, and then like it also gives a competitive advantage or an entry barrier for others. Actually, right? So that also adds to that ESG, like that whole sector itself might be having those ESG concerns, right? So I mean, do you see any significant proof that the big investors have avoided that sector totally? No, right? They are still investing into that sector, right? So I understand that from a company's response perspective, yeah, they have to be responsible. They have to make sure things don't go bad for the environment and all. I get that, but from an investor's perspective, like do they simply rule out such companies, or is it like it's just an add-on kind of thing? If they see a value, if they see a company like that with a bad EH rating but at a good value, uh, do you see them ignoring it, or do you see them still investing in it?
uh, yeah, so I mean, I will give you a simple answer, like do a case study of Hikal when it was trading at probably 100 rupees, probably 170 rupees. What was happening during that time? I mean, like some hint I will give, like something has happened to their Mahad plant, and then you can do some more research on that side, and why the market has given some re-rating to it, and then I think you will able to connect some dots. So it does matter. So generally, like these big guys would like to invest a good amount of chunk with well regulated companies with good ESG things. But if you as an individual thinks right now the company is not good with the ESG parameters, but by your scuttlebutt or by your research capabilities you came to know that no, the market have a bad understanding or a wrong understanding of a business, and you have a bit better understanding compared to market as a whole. That's why you are getting that stock very cheap and you are expecting some re-rating. But but for that you really have to have some edge and some extra information and better research compared to market as a whole, so that you will able to get the dual advantage of the earning re-rating as well as the bit like earning growth as well as the re-rating, the growth due to the re-rating.
Thank you.
Yeah.
Jagannath, you want to go next? Also, guys, if you have any questions, please raise your hand and give me a heads up. Like, send me a message about your question. We don't want any trolls coming up. So yeah, please just message me your question ahead, and I'll pull you up. Raise your hand. Hand opening is open. Hand raising is open. Sorry, Jagannath. Sorry to keep you waiting. Go ahead, man.
No problem, bro. Thank you, Sasank sir, for the insights today and steps you are providing on YouTube as well. Can you throw some light on IDFC First Bank as you were tracking it earlier? I mean, how you think this bank is standing among other banks right now?
Shashank, you're on mute. Hello.
Yeah, I think I lost the voice. Can you repeat, please, if I'm audible?
Yes, yes,
Jagan.
sir. Uh,
Yeah.
I, I was asking, can you throw some light on IDFC First Bank as you were tracking it earlier, as I can see on your YouTube videos? How you think that this bank is standing among other banks?
Yeah, sure. Uh, so just to give us some basic understanding about, I think there is a echo.
Mohit, yaar, can you mute yourself?
Okay,
Uh,
sorry.
yeah, no worries.
Uh, yeah, so banking as a sector, if you check, it's a one of the very difficult sector when economy goes into a downturn, and it's a same for the all the banks. If you just wanted to understand in a very simple way, just check the returns of the banking sector for last 1 year bank nifty returns, so they probably will have the very less returns compared to some other industry or some other stocks. So banking is that sector where basically you get your profits or you generate your revenue when there is a outflow of money. So or when you give more and more loans, you probably will have more and more revenues, but the question is about the profitability. So until and unless you don't collect well, you cannot have the good profitability, and you cannot able to make very good returns out of a banking sector until and unless your focus is more on a understanding how what are the collection mechanisms of the banks. So I think banking is not about lending; it is more of a collections. So right now, if you check what is happening with the say RBL Bank, I don't wanted to go very deep into it, but just very basic understanding is like when when there were not any headwinds, or when everything was good in economy side, and uh, like when everyone was lending. So so generally during that time the banks don't worry about what is their lending quality, or what kind of loans they are giving, because most of the time they used to collect the money back. But I think the capability of any bank will understand when there is a downturn and how well they can collect. HDFC Bank is there, is a HDFC Bank for a particular reason, because their collection mechanism is strong, which has developed over the period of time with by Mr. Puri. So coming back to your question related to IDFC First Bank, So yeah, I think the leadership is good, but I think the start of that bank may not be that great because it was a merger between Capital First and IDFC Bank, where IDFC Bank has some legacy loans into various sectors like construction related and other, while Capital First had into the retail segment. And after COVID, you know what has happened on the retail side. So I think the leadership is good, but there has been a very good, you can say, the dilution after or during COVID period. So that's actually keeping me away from IDFC Bank because firstly there is uncertainty due to COVID. Second thing, there has been a capital dilution, and then I was invested into it personally. I It was my one of the mistake which I have done. Probably I mean the mistake where I actually got decent profits, but it was, I think it, I'll treat it as an opportunity cost for me. So for example, I have got about 90 to 100% returns in last one and a half years into IDFC First Bank. If I would have invested that into my own core domain or the sector, like Deepak Nitrate, for example, at that price, I would have got about 5x, and I was tracking that stock during that time. So I think it was opportunity cost for me. I have not lost in rupee terms. But if you check what will happen in the future about IDFC First Bank, probably they have right now a very good CASA, and they have come up with the strong brand. Uh, but the question is again about the dilution, and I don't like that business which actually keep on diluting and taking the funds from a market at a regular interval. Instead of that, I will buy that business, or I'm interested into that business where actually it does a buyback, or it actually not ask for the capital from a market. So so that is my understanding about the banking as a sector. So so if you wanted to be or invest in on a finance side, probably good opportunities are the gold loans, because there is asset underneath it, and if something goes wrong, those NBFCs or gold finance are able to recover their, and that's the reason they have very less NPAs. uh, it comes with some cost or some, you can say, the drawbacks of the growth, because growth is a bit limited. But definitely, you check what has happened with these big gold finances like Muthoot. So that is, I think, my call. Right now, I have not invested into any bank because I feel there are much better opportunities compared to banking. At least for now, if I get something better in future, I may look into it. But right now, I am not much interested into that as a segment. Probably I might be wrong, but right now I'm taking that call.
Thank you, sir. Thank you so
Yeah,
much.
thank you.
Aman, go ahead, man.
Yeah, hi Shank. Uh, Good to hear you. So actually, I have a query regarding Solara and IOL. So you just mentioned that Solara is having a prominent this thing revenue from the API space, that is the proven salt which they are manufacturing. So same way, IOL Pharma is also a leading player in this segment, and I guess they have 35-40% share, global market share of Brufen. But if I check that IOL Pharma, the revenues are dipping and even their margins are slipping by 8 to 10%. But can you comment on this thing that if they are producing the same salt and they have global clients, so I mean, why is there difference in the revenues or difference in their margins?
Yeah, thank you for your question. So, as I mentioned, you can watch my probably a video which I have uploaded on my YouTube. Is the commodity is the same. Ibuprofen is the name of the product. While in case of IOL chemicals, they are into spot market. So the meaning of the spot market or the term means that, like, let's assume the ibuprofen 1 kg price is like, let's assume $18 per kg. So if you are on a spot market, you can actually able to sell at $18 per kg, but which is the case with the IOL. So if you check the margins of IOL during a good period, probably it might be better than Solara, which was probably last year or a year before that. But it is a significant disadvantage when the cycle turns, right, which is the case right now. So so when those prices of ibuprofen goes down from $18 to probably 11 $12, which is the case right now, so IOL chemicals actually have to sell it for 11 or $12 because they don't have the long term contracts, which actually Solara have. So Solara gets bit of a, what you can say, the better prices, and that's why the profitability is bit better during the down cycle compared to IOL, and that's what has actually happened. If you check the results of both of the companies recently, Solara has done bit better compared to IOL. So I feel long-term contracts are bit better compared to having the spot market relations or spot market contracts. So that is the reason.
So then you are saying that their customer base is entirely different, or there is only a difference between the spot and long-term contracts only for this variation?
I think a company has not mentioned exactly who are their customers. Strides is their one of the customers for solar also, but I think there will be some difference into customers. The Because it depends on the what is the relation between the manufacturer and the customer. If the customer is actually interested into very long term business with the manufacturer, and they are more interested into like the supply or consistency of a supply, generally if you check, the customer looks for the three things from a manufacturer. First thing is what quality of a product they are offering, second thing is how consistently they are offering, and third thing is the price. So it depends on the relation between the customers and the manufacturer. So I think with this logic there might be some difference between the customers. There might be like the Solara might be the preferred supplier, and second supplier might be the IOL. So that also can possible, but definitely Solara have a bit of upper edge because of their long term contracts, and right now they are doing the backward integration, which actually IOL chemicals already have. So there will be, I think, a good comparison, or Solara will get some advantage in future because as they have the backward integration with them. Only I think IOL capacity is higher compared to Solara.
Thanks, Ishan.
Thank you, Aman.
Mohit, go ahead, man.
Yeah. Hi, Sashank. First of all, thank you for doing it. Great insights. So, thank you. My question is about uh, an animal pharma company called Sequent Scientific. So, what went wrong? Because things were going great, everything was like were aligned, but all of a sudden the stock prices started to fall, and the management keeps repeating that it is just a minor blip and things will get back on the track. But for some reasons, market seems to be refusing to believe what management has to say, right? So how do you see things panning out in, let's say, in next 2 3 quarters? Thank you.
Yeah, thank you for your question, Mohit. So what went wrong, I think, is the valuation. So the stock was valued a bit higher compared to what it was worth. And along with that, the headwind has came from a China end. So as you might be aware that last quarter, or actually this quarter, during October November, the coal prices increased a lot in China, and that's why like these production plants or whatever raw materials they were manufacturing in China, the supply actually has gone down, and so the prices has increased for those raw materials. So Solara has actually, sorry, the Sequent had some dependency on a China side, and that's why actually it got hit on that side. The second, there are actually multiple reasons which I can give you, or this was a kind of a storm for that company. The second could be the Turkish lira, which Sair also has mentioned. So they have some 10% dependency from the Turkey. So Turkey as a geography, if you check, I think it's a good business. And once they will start exporting these medicines or these drugs out of Turkey, I think that will start adding into their revenues, and that headwind might be limited. And still, I think like that 10% dependency is not very high dependency. It will uh, that is not the thing I think to worry much upon, at least right now. And third thing which gone wrong, probably it's not wrong, but the thing what has happened during the COVID time is most of the customers for Sequent actually started stocking the final formulations, or let's say the the APIs. And what has happened after that, as those customers already have those stocks with them, so they are deferring their orders from the Sequent. So I think it's a delay of a order. The same thing has happened in the case of, let's say, for example, PI Industries during 2018, when there was a global merger and acquisitions were going on. So similar case, or one of the reasons, I think is a similar. And then apart from there are some other troubles which are going with the on this industry. But I feel most important thing which one should track is the competition. So you have to ask yourself, like, has has there anything which has happened, like when the Geo has entered into a segment with lot of capital, with lot of backing of different investors and promoters. I don't think that has happened in the case of animal pharma as an industry. I hope that helps.
Yeah, thanks, man. Thank you.
Thank you.
Rahul, go ahead, man.
Thanks a lot, sir. And first of all, thank you, Shashank sir, for such a great session. Sir, my question is related to the music and streaming industry. Uh, my question is it a boat long sailed as market has awarded it to such valuations, or one should look at it as a growth story in beginning, as the opportunity size is humongous? As you said today, that one must not stick to just price, but also focus on growth as well as you see price. So how do you look at it, sir?
Yeah, thank you very much for your question. Actually, when Sahir has asked me about what are the sectors apart from chemical and pharma which you're tracking, I think, or invested into, I think music is the one of the best sector which I have studied till now. I mean, it is a fantastic sector, and I'm very bullish on it. It has it has all the components, like it has a high growth because there are tailwinds, because probably the reasons, like what is happening in India, the penetration of internet after Geo came. Like right now we are also having the session on just our mobile, probably at the free of the cost for probably the speaker as well as the listener, because we don't have to pay anything to the clubhouse, and probably on a Twitter as well. So so that is happening due to, like, this gift which we are getting from these telecom providers. Uh, so so you can think about, like, huge tailwinds, probably huge growth, and at the same time this sector actually have two three other things also with it, like probably what you can say is very high ROC kind of a business, because you don't have any assets. Only assets which you have are your songs, right? It is a kind of a intangible asset, you can call it, but you don't need any plants to record a song. You don't need probably any employees, like huge employee base to record the song. it is more of a contract kind of a thing. I will, for example, with Atif Aslam, I will have some contract for 3 years, or probably by song to song also. So, so if I wanted to produce, let's assume 50 songs in next 3 years, I don't have to hire more people, right? It's more of a what kind of what you can say, the goodwill which I have created in last 20-30 years. Based on that, the people will associate with me, and that is a big advantage, I think. Another very good part of this industry is like it's a very basic need, I think. You need a food which you eat, you need a water, you need a place to stay, and fourth thing is probability, you probably is the music, uh, which you like to listen every day. And if you might have noticed that, uh, like we keep on listening same type of music over the period of time. So probably the songs which I was listening 10 years back, still I am listening the similar kind of a song. Definitely I am listening the newer songs also, but I have some relation, or I have some, what you can say, the connection with the older songs, with some event might have happened in my life probably 10 years before, and I will relate that song with that event. So like what Warren Buffett says is, you have to buy that business which can have the high repeatability. So consumers should keep coming uh, to your business and keep on buying that particular song. So so if you understand this value chain of this business, uh, which is basically start with the producer, and uh, then basically there is a composer, and then there is a label, and at the end there are the different platforms like Spotify and all, ghana.com. So if you check the highest profits which are earned out of this complete value chain is by the labels, I think. Because the song which I'm going to produce today with my say singer, I will give him some xyz amount, I will settle, I'll have a deal with him uh, today, and I will settle it off. But the incremental revenues which I'm going to get out of that song probably is for next 60 years. And that is the big advantage. And as a human being, we have developed, or we have that, what you can say, like we keep listening the similar songs over the period of time. And right now, after this introduction of the YouTube and free internet, uh, probably the issues of copyrights and all, I think they are like far behind us. Because if I'm getting a free content on a YouTube, on a click of a button, why will I go to the some different sites and download that song and put that into my mobile, and then I will listen, which probably most of us used to do before, at least 7 8 10 years before. So what is happening is, I am getting my content, I am able to listen to those songs, plus music labels also getting the benefit out of it, because it depends on the per view basis, or based on the per package basis. So I think this industry have significant tailwinds with it. There has been like good growth which started, and I think it will last for a very long period of time. Plus I was reading some articles that the NFT thing is also possible into this industry, which actually has not started yet. So that is also can be the next trigger. Uh, then, as I mentioned, it's a very asset light kind of a model, very huge ROCs, and I think like high entry barrier also, because which I was mentioning earlier. So let's assume tomorrow I wanted to start any music label. I cannot start it because I cannot get probably 30,000 songs, or 1 lakh songs, or 1,30,000 songs in next 5 years, because that is not possible. I cannot buy that from a market. Only thing I have to do is like I have to acquire some other label, and I have to take their portfolio and start getting revenues out of it. So I think as and when we progress ahead in a time, like for next 5 or 10 years, it will be very very difficult for the newcomers or new entrants to enter into this industry, and that's why it also have the very, I think, high entry barriers also. So that is my understanding of music industry. And as you are mentioning about the valuation, I think it's just a start. Like we probably should have the very very good growth for at least next 3 to 4 years. I don't know what will happen in 20 years. Probably it will do good, but whatever I understand right now today, it's like we can have a fantastic years in next 3 to 4 years, at least.
Shashank, sorry, Rahul, go ahead.
Uh, Sorry, sir. Thanks a lot, sir. Sorry to stretch the question, but I just had a one more small question. That how do you find Udly can benefit from the OTT penetration and OTT trend that's going on? And is it like the music label industry with the very asset light and reputation, and the Udly doesn't have that benefit, right?
I mean, I have not studied in very in depth, so I cannot comment on it. Sorry for it. And probably I'll study it and then I can come back to you. But right now, I don't have much understanding.
Okay, thank you, sir. Thank you.
You're welcome.
Shashank, quick question before we move to Sanju. Could you elaborate on the risks as well? For example, India has maybe the lowest data cost in the world. Suppose that were to rise, would that be a hindrance in some sense, or any other risks you see for this industry?
Yeah, good question, Sahir. So on a risk part, data cost may not be the risk, because uh, see, like right now, as you might have started noticing that the Geo and probably Airtel also increased a bit of the rates on a monthly and different packages, but they have over the period of time created that, what you can say, psychological thing, that until, I mean, I as individual, I mean, is very, what you can say, uh, I mean, the internet what I'm using right now, it's a very easy thing for me. So I don't worry much about, like, if I'm paying right now 250 rupees or 300 rupees per month, or 375 or 400 rupees. I should able to get that access to that information or whatever thing which I'm looking for. So so actually they have changed our psychology. I remember that when I used to go for a college, I used to put up some recharge of like what, 100 or 200 rupees for 100 200 MB for a month, I think, something like that. So that psychology was very different. I used to keep switching on and off my internet when I have to want to message someone or watch some video or something. I used to on my internet. Right now my internet on my phone is like on for 24 hours, because I'm not bothered about the cost associated with it. And so is the case with, I think, in future. So I don't think the cost which are right now will go back to that level which they were, I think, about 6 7 years back. So that is not very big, what you can say, the threat can be, there is a trend which is, I think, started developing, is individual singers, which don't wanted to associate with any label. They wanted to create their own labels, or probably they wanted to associate with those companies where they are offering a better percentage revenue share, or they are giving them as a platform, and then the singers are coming out of it. But still it is very difficult thing, because as an individual singer, how much songs you can sing in your whole lifetime. So so and plus, it's not about only singing a song. It is also about how well you market, what is your balance sheet strength. So as an individual, it might be very difficult for him to market the things, and like, he might have the very good talent, but the question is how well you can do and do the marketing, which these big labels can actually. So I mean, right now I don't see there are many big threats, at least for now. If we have the very high piracy or something, then it might act as some negative point, but which I feel may not happen because of the free content which we are getting. I hope that was helpful.
Yep, that was great. Thank you so much. Sanju, last question from you, and we're going to pull up Vineet also after that for the last question, and then we'll end the session if that's all right, Shashank.
Yeah, that would be fine. That would be fine.
Yeah, thanks, Sahir, and thank you, Shashank, for such a valuable and in-depth session. I have two or three questions. You told a little earlier that do not overpay for any specialty chemical companies like Clean Science. Okay, we know that there are a lot of entry barriers, and then they are into this complex green chemistry also. So, but what creates alpha in a portfolio or for a stock is its P re-rating, right? So, what prevents something like a Clean Science, which really does not have any competition, from having a peer rating? So that is my first question. Second question is, given that internet is a multi-decadal structural theme, what do you think of companies like Nika? Because they look very interesting to me, Nika and RateGain, because one is into cloud SaaS travel, one is going to get into video commerce and stuff. So what is your thought on these two companies? And if I can just sneak in another question, inflation is going to rear its ugly head very badly, I think, this year, because we have been at low inflation now since a couple of years, but I think it is finally going to catch up. Which sectors do you think will pay the brunt for it, and which you think will stand to gain from it? Thank you. Yeah.
Yeah, thank you for your question. So I'll probably start with the first one. So P re-rating, you had asked for, like Clean Sciences. So I think like the wealth which you create at the end of the period of, like, say, 5 or 10 years in a long term, is basically like depends on two things. One is the P re-rating, and second is the growth. uh, and most of the wealth, I think, you will create when you will have the both forces acting together. You will I mean, the company able to grow by 20-25% for a long period of time, probably 5-10 years, and the 10p stock goes to no, I mean 30p or 35p, which has happened into many chemical companies. Great example would be Deepak Nitrite. So in the case of Clean Sciences, definitely it's a great company, great management, great products, high entry barrier, process innovation. But the question is it a good investment? Which I feel may not be, because, let's say, another good point about Clean Sciences is that they don't have the patents related to the products or processes which they have, and the reason which management has given is that uh, it will be quite difficult for them to enforce those, like the things which, if something goes wrong, so which I feel is a bit of a risk, because if some other company started producing with the way they are producing, and the stock is priced at price to perfection, then I think, I mean, like what market can do, and what has happened in history, like in the case of DHFL and Yes Bank, and like market doesn't take longer time to devalue the stock. So that's why I generally stay away from very high valuations, like extremely high valuations, if there are not very what you can say, high entry barriers, or something like which I am not comfortable with. So probably that would be my explanation. I think, is it fine, or like you
No, no,
wanted to
no.
ask
I just want
something?
to know your view. That's fine. That's okay. Yeah.
Yeah. So that is my
Yeah.
view. I'm bullish on a business, fantastic business which they have created. But as an investor, I will generally stay away. If it comes down and comes to a fair valuations, I might look for, because my margin of safety will increase from that point of time. And another thing is, like, we have to consider that we have 5,000 listed stocks, and we have to make a portfolio of about 20 to 25 stocks. So it actually goes, I mean, we have the enough options which are available. Second question you asked about the Nika. So I
Yeah.
may not be very competent person to comment on it, but I think the industry is very good. the brand which they have created is excellent brand. If you ask to any lady, any uh, like your sister, your any friend, I think most of them are using the products of Nika. So no doubt about the business. Again, like valuations, I'm personally not able. I'm not understanding like because I am also bit new into evaluating and giving the valuations to the new to these new age companies. So like I will generally take a step back and wait until I understand or develop that competency of understanding like these businesses well, and understanding how to value them in a efficient way, which I think right now I don't have, and that's the reason I may not go ahead and buy it. And another thing is like, finally when you'll make 100 rupees, it doesn't matter if you invest in Nika or if you invest in Deepak Nitrite or if you invest in some other stock, right? So until and unless I am able to grow with whatever I know, and I am able to generate that alpha, I think I'm okay with. And another, like as I mentioned earlier, I need to really understand what are the entry barriers into that industry and what is the growth. Definitely growth is there in Nika and it will accelerate in future. Entry barriers might be the question, and the competitive structure. So until unless I don't get the answers for this, I generally will avoid investing into it.
So coming to Nika, like you're saying about this high PE, I mean, I think it will easily grow at 40 to 50% year on year because, as you said, the penetration and the brand it has created. Will that not accordingly discount the PE in future? I mean, is the market not paying a little bit upfront for its steady future growth, which it is envisaging, that too for multiple years?
Right, right. Yeah, I agree with you on that point. Definitely, market is smarter than we as a individual investors. So, like it is discounting the future growth in built into particularly current valuations. But see, I as a investor have the limitation, or I have kept some basket in which I think I am bit better. So my market cap requirement is also bit very, what you can say, the strict. So I don't generally invest into very big size companies, like at least on a market cap size, which currently market is giving for the say Nika uh, or this Paytm or some different companies like Policy Bazaar and all. So like I will personally avoid it, but definitely Nika can grow at very high rate. But I won't be a investor probably today. If tomorrow I understand the business better, still I will think, because I definitely have many other alternatives with me compared to Nika. That is my personal understanding.
Yeah. Yeah. And if you can just quickly answer my third question, which I asked inflation, because inflation is definitely going to come, which sectors stand to benefit from it? Because I think that will alter the returns a lot in 2022. Okay. So, which sectors stand to benefit from it and which possibly will bear the brunt?
Yeah, so inflation, yeah, definitely it can go up maybe in future, but exactly no one knows what can happen, if it will go up, down, whatever sideways in a long term. So, and investing in a stocks would be the best, what you can say, the hedge against the inflation, because you know what happens to if you invest into FD, and if inflation say goes down, or goes up. So I think investing in various stocks would be the good hedge. It depends on which kind of stocks you invest into, and I am not that of a macro kind of a guy. I generally look for a broader picture. I Because for me it's more of a story of a company, it's not a story of a sector. So for example, I will give like let's assume like few examples. I think that will be bit better to understand. So let's assume like Poshak. So right now they have about say 4,800 metric tons as a capacity, and they are into this chemistry for about 20 30 years, and they have developed that competency to set up the plants and get that particular product out of it. They have the good backward integration. They don't have any dependency on the China. They have about 80% gross margins, and probably they already have started on a contract manufacturing side as well. Um, so the question is like, and plus they are increasing their capacities by 3x. Um, so I think, I'm not sure how much dent they will have, even if the inflation goes up or down uh, in a long term. If the story is good, if the management is good, if the growth going to come, I think like they if I'm expecting they will grow by 25%, they will end up maybe growing at 18%. Still, I think it's okay with me for some time, and then later the growth can come. So for me, I think it's more of a story for that particular industry, or that particular, not industry, that particular business. If the business keeps on delivering, I mean, I am okay with it. That would be my call, basically, on a inflation side.
Yeah, thank you so much. Thank you.
Yeah, thank you.
Vineet bhai, go ahead.
Hi Sahir bhai, hi Shashank, and good evening to everyone, and very very happy New Year to all the listeners and to both of you as well. Uh, Shashank bhai, small thing. I joined the session very late, and that time music industry was being discussed. If in case you have already discussed the demerger of tips industries, I will just do a replays and listen to it. But just wanted to have your thoughts on if in case when you value a music related company which is publishing the content online, do you think market cap to impressions or impressions to market cap is a good metric to look at them, or is there some other metric you want to have a look?
Yeah, thank you for your question, Vineet, and a good question. So tips demerger, if you check, so just to give a brief background to those who don't know about this demerger. So tips have two divisions into their business. One is the film side, one is the music side. So whatever discussion we had till now was, I think, related to music side, but there is another element of the film side. So initially, when I started understanding about this company and this industry, I was very negative on a film side, because I have checked the capital allocation of the management, and they are not able to do any like very good profits for last about a decade. And it's not only with the tips; it's the same story with most of the film based companies. Like Sarigama also has not done very good until last 1 or 2 years. But I think after the pandemic, or after like from last 2 3 years, the segment is reviving as a film segment, because we started using more and more of a OTT content, and Netflix and Amazon and different platforms like Hotstar and all. So I think the film as a business also will do well. And one of the good, what you can say, the point related to it was the profit posted by the tips on their film business in quarter 2. So they have posted about some 7 8 10 crores of profits after selling their one of the movie called as Bhoot Police. So I think this is also a start, probably on a film side, which might be turning around. Definitely the market won't give the valuations on a film side compared to what it is giving on a music side, but definitely, as and when the markets will get matured, they will start posting consistent profit if it is a OTT thing. And OTT or film as a, what you can say, a sector, or when you're watching film on a OTT as compared to when you're going into the theaters and watching it, there is a significant difference. And the guys who are paying for the premium services as a percentage of the total population might be very less compared to other developed countries. So I think opportunity size is again very huge. So I will give it some time Initially, my understanding was a bit different on a film side, but after seeing these recent results, I think there is a good potential which is available on a film side as well. So what I'm expecting is after a demerger, there will be a significant. I mean, market will just throw it away and give it like a very low multiple. Probably that might be a good entry which we can probably get.
So, Shashank, the other part of my question was since most of these music label companies make revenue from impressions, so would market cap to impressions or impressions to market cap be a good indicator in terms of value?
uh, Impressions, I think you are mentioning as a views probably, like
Yeah. I mean views only.
yeah, right. So uh, yeah, because every view is counted in their revenues, right? Like if it is the revenue share model, like for example YouTube. So as I'm also a YouTuber, so more views I will get, more revenue I'll get out of it, right? So there is a direct correlation between the views and the revenue for that particular platform. It might be different association with different platforms to platforms, like
Shashank,
for us.
Shashank,
Yeah.
before you deep dive into it, I just wanted to have a perspective on it. Why? Because most of the people think that bigger the library, bigger the view. But since Saregama has a bigger library than Tips, so it has bigger views. But I am of a very different thought process, and I feel that if the content is good, the views will be good, and hence even if it's a smaller library, it can generate per content view higher than what it has been generating for other players.
Yeah, right. So, yeah, so I was telling initially about the views and how it is related with the revenues. Let me come back to your question. Yeah, definitely it matters what is your content, because user is, or the listener or whatever viewer is coming to your platform because he is liking your content. Probably it depends on which year catalog you have. Do you have 90s catalog or you have 60s catalog? Do you have it is in an audio format, or do you have it into a video format? So I think in case of Saregama, like the catalog which they have uploaded on a YouTube, it's like a more on a audio side. So that's why Saregama probably might be getting a bit lesser views. And if you check the subscriber counts also, in case of Saregama, it is significantly lesser compared to Tips. Tips has about 14 million subscribers. Saregama have much lesser compared to it. So that would be the reason, like because of video versus audio kind of tracks. And it really does matter what kind of a content you have. If you have a great content, even if you have like lesser number of songs, still you can have a very high views. And if you have a high views, definitely you will have the higher revenues and so the profitability, because uh, your variable costs are very small in this kind of a industry. So if you are generating, for example, 50 crores of revenues, and your fixed cost as are, let's assume, 10 crores, and your profit is say 40 crores, the tomorrow if you generate 100 crores instead of 50, your expenses won't go to like 20 or 30 crores. It will jump from say 10 to maybe 12 or 15, and remaining would be your profitability. So I think it's directly proportional to your views, and views are directly proportional to your content. If you upload a good content, you'll get a good views. If you'll get a good views, you'll get a good revenues. Get a good profitability, and say ROC, and say the valuations as well, I think.
That's about it, Shashank, and I'm just looking forward to the merger. Let's see how this plays out. I still do not have any positions there, but I'm contemplating. Let's see.
Thank you for your question, Vinit.
So should we end this now?
I hear if you allow, I would ask one last question.
Shashank, is that all right?
Fine.
Yeah, I'm okay with it.
Okay with it.
I'm
Yes,
getting echo.
Shashank, we Indians have a tendency to avoid advisory services, right? And if we see in Western countries or that side, the importance of advisory is such that most of the population go for advisory of one sort or the other. So I would like to advisory and what how it could be beneficial, because a person who is just entering a market and who don't know an iota of market, and they are investing their hard earned money, so they are very prone to risks. So in such cases, how advisory can really help them, and apart from that, how mis-selling has impacted the advisory services. Thank you.
Yeah, thank you for your question. Yeah, it's a good question. So see, if you check market as a whole, stock market as a whole, I don't think have a very good image in most of the people. So if you as a kid will ask your parents that I wanted to have a career in a stock market, then they will tell you like आप क्या 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 ये सट्टा कर रहे हो या क्या गैम्बल कर रहे हो. So that is the perspective, at least in India, with most of the household we have. And same is the case with the advisory. Actually, if you check like a small bad, or like the people with the bad intentions, actually due to them the image of the industry is not that great. But uh, but to be honest, I think the person who is not full time into a market and wanted to invest into it, the best way is to have an advisor or go with the mutual fund with good track record. So you have to understand, you have to check the track record with whomever you wanted to deal with or you wanted to park your funds with. And actually advisor or other whatever form, PMS or different forms, mutual funds or individual advisors, plays a significant role if they have the good credentials and if they have the good, what you can say, uh, the track record. Don't go for the tips, don't go for the intraday calls, don't go for like the person who don't have any credentials, because that seriously can have a good amount of risk associated with it. Right now it's a bull market, everyone will tell you good stories about it, but I think you might be uh, come to know when we'll come out of this phase, what has happened between 2018 to 2020. I'm not sure how many of you have tracked that market. It was a very difficult period, and it was a very great learning for me as well. So you have to have check the background of the person, and what credentials they have, what kind of research basically they have done. So I think it's more of a research, it's more of a knowledge, what knowledge that person have. And if that has that person have great knowledge, or as a company they have done very well. Forget about like what returns they have given, but the process is very important, because returns uh, are dependent on which cycles market we are in. If you think about 2018 2020, the returns were low. That doesn't mean that person or that advisor or that mutual fund is a bad, but the process is very good. They can come out of that underperformance very easily. So I think, I believe a lot into process rather than outcome, because outcome is basically, what you can say, is is after a process. If you have a right process, you will have the right outcome. If you have a bad process, you will have a bad outcome in the long run. In a short term, anything can happen. With the bad process, you can have a good outcome. If I'll buy a call option at five rupees, and if Nifty opens 500 points up tomorrow, will I be a good investor or advisor or a speculator? I think I'm a bad person to advise. So, but these things happen. So that's why the credibility and track record is important.
Yeah, sounds good. Thanks, Shashank.
Yeah, thank you.
All right, guys. Shashank, should we end then?
Yeah, sure. I think we have covered enough questions. If anyone have some more questions, you can ask me on a Twitter. I'm there on a Twitter with the handle Value Educator. Um, or you can watch my YouTube videos if you have any suggestions or any more comments on a particular stocks, you can comment on those videos. And yeah, I'm reachable. I try to respond to whatever way I can. So let me know if you have any queries later on a Twitter or
So
in
yeah,
a comment.
guys, just to reiterate, go follow Shashank on Twitter at Value Educator, and please check out his YouTube. It is really informative. It is really insightful. I promise you, you will gain something from his videos. And there's something for everyone on his YouTube. So check his YouTube out at Value Educator. And yeah, like you said, if you have any query, follow up with a message on Twitter at Value Educator. Uh, yeah, and follow the club, follow Investors India. I know we had some hiccup with Twitter Spaces today, but for the for I guess once we got onto Clubhouse, it was pretty straightforward and seamless, and it was a great session. So thank you so much, Shashank. Thank you so much for doing this. It was really a great, insightful session. Hope you guys enjoyed it, and thank you for those who waited and waited through the 10 minutes of bad Twitter Spaces. But yeah, give Shashank a follow on Twitter at Value Educator. Check out his YouTube. Again, it goes by Value Space Educator. And give me a follow if you enjoyed my moderation. I try to do these pretty often with different experts on different industries. So yeah,